President Donald Trump has unveiled a landmark trade agreement with Vietnam, marking a pivotal moment in the economic relationship between the two nations. This announcement signals a major shift in American trade policy, one that could reshape the balance of power in the region. Announced on July 2, 2025, this deal rebalances the economic relationship between the U.S. and one of Asia's fastest-growing economies, opening the door to new opportunities for both sides. Forged in close partnership with Vietnamese General Secretary To Lam, the White House hails it as a significant victory for American workers and farmers who have long sought greater access to Asian markets. The agreement opens new markets for U.S. goods, from agricultural products to advanced manufacturing, and aims to address a long-standing trade imbalance that has favored Vietnam for years. It marks a dramatic pivot from earlier tariff threats and introduces a new model for Trump's America First trade philosophy, emphasizing negotiation over confrontation. The U.S. trade deficit with Vietnam reached a staggering $123 billion in 2024. This deal is designed to reverse that trend and create a more equitable trading environment. Beyond economics, the agreement signals a strategic alignment between Washington and Hanoi, strengthening ties amid China's growing influence in Southeast Asia and the South China Sea. As we break down the deal, we'll explore its core components, the touted $400 billion figure, and its far-reaching impact on American agriculture, manufacturing, and everyday consumers. This is a story of high-stakes negotiation and bold economic strategy, with global consequences already being felt in financial markets and international relations. Let's dive into the specifics and see what this new era of U.S.-Vietnam trade means for the world, for businesses, and for the future of global commerce. The agreement between the U.S. and Vietnam is built on three major pillars that are set to fundamentally reshape the landscape of trade between the two countries. This deal marks a significant turning point in their economic relationship, with far-reaching consequences for both nations. First, all tariffs on U.S. goods, especially agricultural products, are eliminated, granting American exporters unprecedented, unrestricted access to Vietnam's rapidly growing market. This is expected to boost U.S. farm incomes and open new opportunities for American producers, from soybeans to beef and beyond. Second, a flat 20% tariff will now be imposed on all Vietnamese goods entering the U.S., impacting over $136 billion in annual imports. This is a dramatic shift from previous trade policy and will affect a wide range of products from electronics to textiles. The move is designed to address the persistent trade imbalance and encourage more domestic manufacturing in the U.S. However, it could also mean higher prices for American consumers and businesses that rely on Vietnamese imports. Third, a steep 40% duty will target goods made in other countries such as China, but routed through Vietnam in an attempt to bypass U.S. tariffs. This measure is intended to close a major loophole that has allowed billions in goods to enter the U.S. tariff-free. Together, these measures create a new trade dynamic, offering unprecedented opportunity for U.S. exporters, but also introducing higher costs for importers and everyday shoppers. The ripple effects will be felt throughout both economies. The White House has yet to release a specific implementation date or a list of possible exemptions, leaving many businesses in a state of uncertainty as they try to plan for the future. This deal is not only a bold economic play, but also serves as a clear warning to other trading partners that the U.S. is willing to take aggressive action to protect its interests. It's a transformative arrangement that will force companies to rethink their supply chains and market strategies on both sides of the Pacific, potentially leading to new alliances and business models. While the full details are still emerging, one thing is clear. The impact of this agreement will be felt across industries, businesses, and households in both countries for years to come. The headline $400 billion figure is a projection, not a direct payment. It's a forward-looking estimate, designed to capture the full ripple effect of the new trade agreement over time, rather than a single lump sum. It estimates the cumulative economic value the White House expects over several years, driven by increased U.S. exports, industry growth, and new tariff revenue. This projection includes not just direct sales, but also the broader economic activity that comes from expanded trade relationships. With tariffs gone, American companies in agriculture and manufacturing are expected to expand rapidly in Vietnam. This could mean more jobs at home, higher demand for U.S. goods, and stronger ties between the two countries' economies. The 20% tariff on Vietnamese imports could generate $29 billion in new federal revenue annually. That's a significant boost to government coffers, potentially funding new programs or offsetting deficits. Over a decade, this alone could account for a large share of the $400 billion total. When you add in the multiplier effect of increased business activity, the numbers start to add up quickly. The number is as much political messaging as economic forecast, underscoring the deal's ambitious scale. It's meant to signal confidence and vision, both to domestic audiences and international partners. Economists may debate the math, but the administration frames this as a transformative win for the U.S. They argue it sets the stage for a new era of American competitiveness in Asia. The $400 billion figure is meant to highlight the long-term benefits and strategic impact. It's a symbol of what's possible if the deal delivers as promised. It's not just about trade flows, it's about reshaping America's global economic posture. The hope is to strengthen alliances and secure a bigger role for the U.S. in the region. The real test will be how these projections play out in the years ahead, as the world watches to see if the bold promises become reality. For American farmers, this deal is a game-changer. U.S. agriculture has long faced high tariffs in Vietnam, while competitors from Australia and Canada enjoyed duty-free access. Now, those barriers are gone, opening Vietnam's lucrative market to American products. The beef industry, for example, expects sales to surge as tariffs drop from 30% to 0%. U.S. frozen fries, apples, cherries, pears, blueberries, and cranberries all stand to gain millions in new annual sales. This access offers a vital new revenue stream for farmers struggling with global competition. The deal lets U.S. producers compete on quality, not just price, and boosts rural economies nationwide. For many farm families, selling to 100 million new Vietnamese customers is a lifeline. It's a clear win for American agriculture and a key pillar of the administration's trade strategy. The impact will be felt from orchards in Washington to ranches in Texas. While farmers benefit, American consumers face higher prices. The 20% tariff on Vietnamese imports will raise costs for everything from sneakers and clothing to electronics and furniture. U.S. companies importing from Vietnam must pay the tariff, and most will pass that cost to shoppers. A $50 pair of sneakers could now cost $60 at retail. Large retailers might absorb some costs or shift supply chains, but smaller businesses will struggle. The tariff is meant to boost domestic production, but the transition will be costly and complex. The revenue funds the government, but it comes from American pockets. The White House argues this is the price for fairer trade, but for families, it means a higher cost of living. The deal creates a direct trade-off: export gains for farmers, higher bills for shoppers. Americans will have to weigh long-term policy goals against their immediate budgets. Every trade deal creates winners and losers, and this one is no exception. American farmers and manufacturers gain new access to Vietnam, boosting exports and rural economies. The U.S. Treasury benefits from billions in new tariff revenue, but American consumers and companies relying on Vietnamese imports will pay more, facing tough choices on pricing and profits. For Vietnam, the deal brings certainty, avoiding the crippling 46% tariffs Trump once threatened. While Vietnamese exporters now face a 20% tariff, they keep access to their largest market. Vietnam gives up tariffs on U.S. goods, but those were relatively minor compared to what it sells to America. Both sides made strategic calculations. The U.S. traded higher import costs for export gains. Vietnam accepted new taxes to avoid worse outcomes. The deal reshapes fortunes on both sides of the Pacific, with clear trade-offs for every sector. It's a classic example of how global trade is always a balancing act. The U.S.-Vietnam deal is the result of months of aggressive trade maneuvering by the Trump administration. The year began with new tariffs on China, Mexico, and Canada, setting a confrontational tone. In April, Trump threatened a 46% tariff on Vietnamese goods, sparking urgent negotiations. The administration also floated a universal 10% import tariff and escalated tariffs on China to 145%. A brief truce with China in May allowed focus to shift to Vietnam, leading to the July 2nd announcement. The deal is seen as a model for future agreements, using tariff threats to secure market access. The strategy leveraged tariffs to force concessions and prioritize American exports. This agreement is about more than trade, it's a major geopolitical move. By partnering with Vietnam, the US strengthens its position in Southeast Asia and counters China's influence. The 40% anti-transshipment duty directly targets Chinese attempts to evade tariffs. Elevating ties with Vietnam signals deeper US engagement in the region. The deal gives Vietnam economic and political backing as it navigates its relationship with China. It also serves as a template and warning for other Asia-Pacific nations with large US trade surpluses. The agreement transforms Vietnam into a key US ally, built on shared economic and strategic interests. It cements Vietnam's role in America's Indo-Pacific strategy. In today's world, trade and geopolitics are inseparable, and this deal proves it. The $400 billion US-Vietnam trade deal is one of the boldest and most disruptive in recent memory. It opens new doors for American exporters, especially farmers, while imposing new costs on consumers. The 20% tariff on Vietnamese imports will ripple through the economy, raising prices and squeezing businesses. The administration is betting that long-term gains, correcting the trade deficit and boosting exports, will outweigh short-term pain. Geopolitically, the deal cements Vietnam as a key US partner in Asia's power struggle with China. It's a landmark policy that encapsulates the America First worldview, aggressive, transactional, and focused on US interests. The world will watch as the consequences unfold for American wallets, Vietnamese factories, and the future of global commerce. This deal could be the blueprint for a new era in international trade,